Hi guys, it's Stock Curry, and the Federal Reserve just crashed the markets. You're not going to like what I'm about to say, but you need to hear it. I'm going to tell you everything the Fed said, what they projected, and the impact on you and your stocks. So let's get into it. The stock market sold off following the Fed's rate hike, with the Dow shedding more than 500 points. I'm going to start by showing you what the Federal Reserve projected for future rate hikes. Then I'm going to go over everything Jerome Powell said that caused the stock market to crash. Then I'm going to show you what the impact is going to be on you and your stocks. Let's get started with the summary of economic projections. This is a quarterly report that the FOMC puts out, and it explains exactly how much the Fed expects to raise interest rates by throughout the rest of the year and into future years as well. And it also gives an estimate on where the Fed expects GDP to be in the future, which could give us some insight into whether or not we might have a recession coming up. First, let's talk about interest rates. The Fed raised the interest rate to between 4.75 and 5.0 at this meeting. Now, they are projecting that by the end of this year, the interest rate will be 5.1%. That means one more rate hike. And then by the end of next year, they're expecting the interest rate to fall to 4.3%. And that means 3 rate cuts next year, with an additional 5 rate cuts in 2025. One thing that is telling, though, is that there are no rate cuts predicted for this year. Another interesting thing about this summary of economic projections, or SEP, is that the Fed expects that GDP is going to be very close to zero this year. And a lot of people are fearful that if the Fed is expecting GDP to be zero, there's a good chance it's actually going to be negative, which means we will be in a recession this year. The Fed is also expecting the unemployment rate to rise to 4.5% this year, which can only happen if we enter a recession. At the same time, the Fed is expecting inflation to come down to 3.5% this year, and that probably won't happen unless the Fed continues to raise interest rates. And to go along with that, core inflation is also expected to drop to 3.5%. Finally, taking a look at the famous dot graph, the dots on this graph show where most Fed members expect that interest rates are going to be. They expect interest rates to hit 5.1% by the end of this year, although there were quite a few Fed members that would expect even more than one rate hike, possibly 2 or 3 rate hikes this year, before finally starting to lower rates in 2024 and 2025. Now, even though the summary of economic projections indicate that there's probably going to be a recession this year, the markets really liked the 25 basis point rate hike, as well as the summary of economic projections indicating just one more rate hike before a pause. And the markets actually started by going up. They didn't rally, but they did go up a little bit. Now, it wasn't until Jerome Powell started speaking that the market started to tank. So let's go through what Jerome Powell actually said that caused the markets to crash. Jerome Powell did something very unique at this press conference, and he started by giving a statement essentially saying that the banking system is sound and resilient, and there's no need for anybody to worry. Now, this was really important. The Fed needed to do this. A lot of what we talked about in yesterday's video was the fact that the Fed would have to raise by 25 basis points to show that it's still fighting inflation, while at the same time attacking the bank system problem. And I think Jerome Powell did a really good job of that at the FOMC meeting on Wednesday. The next thing that the markets really liked and continued to rally on as Jerome Powell spoke was the fact that the FOMC had removed the language around ongoing increases in interest rates, and they had switched that language to some additional firming, as well as adding language that the U.S. banking system is sound and resilient. But that's where things started to fall apart a little bit, and that was pretty much the end of the bullishness. Jerome Powell then talked about how the Fed would use all of their tools to keep the banking system safe, but he fell a little bit short about guaranteeing every single deposit, and we'll talk a little bit more about that here in a minute. Jerome Powell then said that the regional bank issues would mean tighter credit conditions, and this is where the stock market really started to sell off. Essentially, what Jerome Powell was saying here is that because the regional banks are in trouble, they're going to issue less loans, and that, in effect, is going to cause the economy to go down. Essentially, it just wasn't really helpful in restoring any confidence in the banking system. Jerome Powell then made things worse by cautioning that the inflation fight has a long way to go and that the process to getting inflation back down to 2% was going to be long and bumpy. That would indicate more rate hikes this year, and the market did not like that. Jerome Powell then said that bank deposit flows had stabilized and that withdrawals from regional banks had slowed down. But in a minute, you're going to see why that was actually a lie. The markets also did not like the fact that Jerome Powell said that the committee had considered pausing in light of the banking crisis, but decided to move forward with their rate hike anyway. And the reason for that is they said it was just too early to tell what impact the banking crisis would actually have on the economy. Then he really drove the nail in the coffin by saying that the market is getting it wrong by predicting rate cuts this year. Jerome Powell made it very clear there will not be a rate cut this year, and that's when the stock market really intensified its sell-off. Then Jerome Powell made things even worse by saying that if the Fed needs to raise rates even higher, it will. He also added that they see the likelihood of more credit tightening. Then Jerome Powell had a chance to turn things around and totally butchered it. He was asked about if there was still a pathway to a soft landing. And in the past, Jerome Powell has always said that they believe a soft landing is still possible and they're going to try to achieve it. This time, though, the language was very different. Jerome Powell said that it's too early to say if a soft landing is still possible. And he said that he thinks a soft landing is still out there somewhere, but they don't really know how to figure out how to make a soft landing happen. This was just a complete disaster of a response by Jerome Powell and indicated that Jerome Powell and the Fed is pretty much expecting a hard recession this year. Then Jerome Powell continued to make things worse by saying that financial conditions have tightened even more than the market shows they have, meaning he expects stocks to continue to sell off once they figure out just how bad things actually are. And that's exactly what the stock market did. It sold off. The press conference was a complete disaster for the stock market. The S&P fell back below the 200-day moving average. The entire technicals just turned 100% bearish within a 1.5 hour period today. It was a complete and total disaster. And that is why I'm personally starting to switch from call options to put options. It does look like the market is ready just to continue to fall. There was no hope of bullishness in the Fed statement or the press release whatsoever. Now let's go into a little bit more detail about what the Fed's meeting today means for your money and for your stocks. Well, for starters, the Federal Reserve did not do anything to help shore up any confidence in the banking system. The bank problems are probably going to make a lot of people think twice, and people just are not as confident as they were even 2 weeks ago. Credit card rates are also going to rise. As the federal funds rate rises, the prime rate does as well, and your credit card rate is probably going to follow suit within about a month or two. And this is a major problem for the U.S. economy right now because consumer spending has continued on a very strong path, even though people run out of money. They're just spending on their credit cards. And as credit card interest rates rise, that's going to make the payments on those rise as well. And that's just going to put more pressure on consumers. Auto loans are also going to get hit. The Fed's latest move could push up the average interest rate even higher, right at a time when borrowers are already struggling to keep up with their monthly loan payments. This in turn is going to have a more serious downward effect on the economy and will probably cause the recession to come even faster. And unfortunately, even though Jerome Powell attempted to give a nod to the greater uncertainty and the banking stress, it just failed miserably, and bank stocks continue to sell off. Regional bank shares continue to fall as the Fed persisted with its rate hikes. Powell said during his press conference that the weakness seen in Silicon Valley Bank was not apparent in the broader sector. He also said deposits in the banking system have stabilized over the past week. Both of those statements were complete lies. In fact, the problems with Silicon Valley Bank, as many analysts have pointed out, are actually apparent in every single bank in the United States, and deposits have not stabilized. I'm going to show you why in a minute. In addition to that, adding to the drop in regional bank shares were comments from Treasury Secretary Yellen, who told the U.S. Senate Appropriations Subcommittee that the U.S. was not currently working on a blanket insurance for bank deposits. That means no unlimited FDIC insurance for bank deposits. So if you have deposits at your bank that are in excess of $250,000, they're not insured. And this doesn't do anything to help bring confidence to the regional banks. And that's why we saw more outflows. PacWest shares fell 17% after the regional bank disclosed additional deposit outflows. So Jerome Powell was just flat out wrong when he said deposit outflows were stabilizing. PacWest showed that, and this is why the bank shares continue to decline. There remains incredible fear in the banking sector that things might at least get worse before they get better. And we don't know when things will get better. We know they will, but how many more banks have to collapse before they do? That's the real question here. And that's why bank stocks continue to sell off. And unfortunately, Jerome Powell gave a strong indication that a recession is most likely on the way. He said financial conditions are tightening after Silicon Valley Bank's collapse, and it could slow down the economy. In fact, slow it down to the point of recession. Jerome Powell said financial conditions seem to have tightened, and probably by more than what the traditional indexes say. The question for us, though, is how significant that will be and what the extent of it will be and what the duration of it will be. We'll be looking to see how serious this is and does it look like it's going to be sustained. And if it is, it could easily have a significant macroeconomic effect. And we would have to factor that into our future policy decisions. So Jerome Powell warned that this was quite serious and that the banking problems that have occurred over the past 2 weeks could cause a significant macroeconomic slowdown to the point of a recession. And that's why Jerome Powell was very weary of saying that a soft landing was still possible. The fact is, this is looking really, really bad. And the fact that the Fed wants to continue to raise interest rates and not cut them this year, that is just a terrible, terrible sign. And it looks like the Fed is going full steam at raising interest rates too much and leading us straight into a hard landing or a major recession at some point this year. Economists right now expect the recession is going to start around September. We'll have to wait and see what actually happens. But right now, it's all bad news for the stock market. And that is why I have switched and am currently in the process of switching from long positions and call options to moving into short positions and put options. In fact, today I did a lot of switching into put options, and on the portfolio today, I made over $8,000 today. It just goes to show that no matter what the market does, whether it goes up, down, or even trades flat, you can make money in the stock market. And if you want to learn how to make money in the stock market, no matter what direction the market moves, I encourage you to come join my coaching program where I will teach you how to trade options and teach you how to make money as the market goes down. If that's something you think you might be interested in, you can get more information on that at weprofitdayandnight.com. That's weprofitdayandnight.com. If you got a lot out of this video, then be a good friend and share this video with your friends and family so that they will know what's going on in the markets as well. And don't forget to hit the like button and subscribe. And if you missed yesterday's video where I gave you a little bit more preview on what the Fed would do and some of the larger impacts that the Fed rate decision is going to have on the market, make sure you watch the last video that I uploaded here.